I've made some adjustments to the London 50 trading model. If you think I'm an idiot for having this many trades, stick around for the video. At the end of it, you're going to be convinced to try this model. What's going on, guys? Mr. Zink here. If you want to go and rewatch the original London 50 trading model video, I'll drop the link to that right here, and then you can come back to this one for the changes. I've made 3 changes to the strategy that have helped me net $10,700 in the past 2 trading days, albeit quite a few trades placed. This is acquired from several months of backtesting the data told me that we needed to make these changes. The first one being we are no longer using previous days 50 for bias. We used to use that previous days 50 to assess whether we were bullish or bearish into the following day. Again, several months of backtesting have told me that we are no longer needing this tool. We no longer need to use previous days 50 for the bias. I'm using the week of August 4th to August 8th for backtesting purposes. If you want to follow along on your TradingView, go for it. So Monday into Tuesday, our previous days 50 drawn in. All right, price opened over previous days 50. We have a bullish bias. We're looking for long setups. But wait a minute, price on Tuesday did nothing but go to the downside. All right, maybe that's just a fluke. Let's draw Tuesday into Wednesday. All right, same thing. Price opened underneath the previous day's 50. We have a bearish bias. We have a gap down there. Maybe we go and fill that gap. Nope, price for Wednesday went up the entire day. I think you're getting the picture here. We are no longer using that previous day's 50 to tell us what the bias is for the day. Rather, what we're doing with that previous day's 50, we're still drawing it in every day. We're using it for reactions. We're using it for levels because the levels are still significant. Previous day's high, previous day's low, previous day's 50. Going over Thursday, August 7th, and I actually traded this one yesterday. This is one of the pictures on here. 50 trades, good Lord. We had 6 trades alone at that previous day's high. We averaged into some of those trades, so that 6 trades ended up turning into somewhere between 10 to 12 trades, all with 1 to 2 M&Q again, up to 4 to 8 M&Q total lots. We had 6 reactions. All 6 printed beautiful 20 to 30 point bounces or rejections in this case. We're still using that previous day's 50, but no longer using it for the bias. Change number 2. We do not, and I repeat, we do not use the opening 15-minute candle anymore. The reason being, data has told me that 45% of the losses associated with this trading model have come from that single candle, that single 15-minute opening candle. That's a data point that I could not ignore. I may not have believed at first, but when I really thought about it, yeah, most of those losses we take come from that opening 15-minute candle. It almost always hits the London 50, London high, London low on the opening 15-minute. You have a trade that you can take a reaction on. Friday's case, we have our London high, London low. Okay, let's say I want to take a rejection there. Price hit that level. I could have taken a rejection, and then it just continued to slice right through it. That's a stop loss there, as the stop loss was a 15-minute candle closure over or under the level that we're taking. Given that we have a 15-minute stop loss, this opening 15-minute candle could have a 50-point stop, it could have a 10-point stop, it could have a 100-point stop. The 15-minute candle is exciting. The opening 15-minute candle is exciting to trade because you have everyone overnight that wants to get into the market. You have volatility with that candle, especially on Mondays, where you have everyone eager to trade for Sunday, Saturday. They want to get back in the market, and the Monday opening candle is anywhere from 50 to 150 points. So that change had to happen. Most of our losses, not most of them, 45% of our losses, so just under half, have essentially been wiped out by avoiding that 15-minute candle. So if you want to start your trading day at 9:45, go for it. And the last adjustment for the video, 3 reactions at one level invalidates that level directionally. I'm going to use Thursday, August 7th to review this. We have our London 50 drawn in. We have our previous day's 50 drawn in again for previous day's 50. We're using that just for level reactions, no longer using it for the bias. And then we are no longer trading that opening 15-minute candle. I did take 1 loss here, trading a move over London high, and then immediately waited for price to come back down to the London 50. This new rule is 3 taps. So we have our first tap at 10:15, second tap at 10:30, third tap at 10:45. I'm going to go down to the 5-minute time frame so we can see just how many taps we're at this level. Our London 50 is this middle line. We had 1, 2, 3, 4 taps. After that third one, no longer looking to go long off that level. That's the directional part of this strategy or of this change. If I'm looking for bounces off of London 50, 3 taps is all I get. So I look 1 tap, upside, 2 tap, upside, third tap, upside. Fourth tap, no longer looking to go long. Now that price has flipped below London 50, I'm looking to go short. 1 tap to the upside, short. Second tap to the upside, short. And then price proceeded down to previous day's high along with London low. I'm taking another set of reactions at those levels. So first one, London low, previous day's high. I can take a long there. Price bounced. Second one, price bounced again. Third one, again on the 5-minute, there were several reactions here. I'm not going to go and adjust it again. Third tap, long again. No longer looking to go long. Fourth one, fell right through. Now we're looking to take rejections back down. First rejection, hit it perfectly, another 100-point drop. Second one, hit it perfectly again, another 100-point drop. And then price continued down for the day. I'm not trading the closing 15-minute candle either. You can do it for some strategies, some models, but I prefer not to touch it. 3 taps is all you get at each level. Anything after that third tap, and this goes for seeing it happen on the 5-minute time frame, seeing it happen on the 3-minute time frame. If you're watching it real time and you're seeing price repeatedly hit the level, you're counting in your head 1, 2, 3. Okay, that's 3 taps. I'm no longer taking that to the upside or downside. Make sure that you keep track of the taps. Anything over 4, anything over 3, no longer using it. 3 and above. Now, if you've made it to this point in the video, congratulations, because you just unlocked the most important add-on that we've made to the trading model. Directional bias. This states that 80% of the time price is trending in one direction, it will continue to trend in that direction. Only 20% of the time will price reverse on itself. If we have an uptrend, there's an 80% chance that that uptrend will continue for the entire trading day, all the way up until that 8 p.m. close. Monday, for example, rather than trying to be a top caller and be in disbelief that price is continuing to push up, switch that bias and look for pullbacks to go long into. This is exactly what I did on Monday. I made about $800 per account, so $4,000 on those 5 XFAs, simply waiting for a pullback to get into. I entered on this 10:30 candle. We had a 70-cent correction. I held that trade for about an hour, and then we had a dollar continuation back to the upside and ended up making a new high day into close. Stop trying to call tops and bottoms. You should understand the statistic states that you are going to be losing 80% of the time if all you're looking for is trying to call that top or call that bottom for the big gain on the day. Wait for a pullback to re-enter that trend. This data also states that 1 out of every 5 trading days is going to have a reversal. That's just statistics. You're not going to have a 100% win rate with a strategy. You're not going to have a 100% win rate with anything. Thursday was that 20% chance. However, if you notice, Thursday trended down all the way until 2:30. So you had 4.5 hours, 5.5 hours of trading in that trend where you waited for pullbacks back to the upside and then got back into the trend. You also had 6 reactions at the London 50 that you could have traded. You had 6 reactions at previous day's high along with London low. And then you had another 6 reactions at that psych level 23,400 on NQ. Beautiful setup for Thursday. That's why I had so many trades. And then the same thing for Friday. We had trend all day today. Yes, we had some dips, but those dips are where you re-enter. Now, I had 84 trades today. A little embarrassed to say so. They were not large trades. They were 1 to 2 MNQ, and if you look at these candles, especially the ones that we had after 1:30, the largest candle we got was maybe 30 points. All these candles, 6 cents, 11 cents, 8 cents, 7 cents, 2 cents, and this is an hour and 15 minutes worth of trading right here. They were small wins, but those wins added up, and that has netted me $10,700 for this week. Along with these 3 changes, knowing the directional bias, this trading strategy likely has an 82% win rate now. This is just for the week. I can't wait to start backtesting this again. Any questions that you guys have, drop them in the comments. If you're annoyed with how many trades I took, thinking that I'm an idiot, so be it. Try out the concepts that I proved in this video because they work incredibly well. This is probably the simplest trading strategy you're going to use. Try it out for a week. Let me know how you like it. Drop a like on the video, subscribe, let me know what you want to see for next video. I'll see you guys later. Peace out.